I'm still waiting.
Me too.
Me too.
Me too.
Me too.
Everyone keeps waiting for the housing market to crash. But what if the market is already crashing out, just not in the way anyone expected? This time it's less 2008 style implosion and more frog in boiling water. The market is fundamentally unaffordable, gridlocked by design, and slowly rugging the path to middle-class wealth. The bad news isn't that the market is going to crash. The bad news is that it isn't. So, stay tuned to find out why. My name is Nick, and you're watching The Coin Bureau. The last time we spotted trouble brewing in the housing market, it was late 2022, and the pandemic-era bubble looked perilously close to popping. Beginning in 2020, house prices were driven to record highs by a perfect storm of tailwinds. These included ultra-low interest rates, government stimulus, higher household savings, increased demand for larger homes driven by remote work, limited housing supply due to the construction delays and labor shortages, and a surge in investor and speculative buying. But this real estate sugar rush was rudely interrupted when central banks started aggressively hiking rates in 2022, as this made mortgages much more expensive. The US average 30-year fixed-rate mortgage rate, for example, increased by 130% within a year, up from 3% in late 2021 to 7% in late 2022. Depending on location and house price, this made monthly payments sometimes 50 to 80% more expensive for the same loan amount. Talk about getting wrecked. As affordability collapsed, many buyers could no longer qualify for loans or dropped out of the market entirely. And for investors who rely on credit to finance rental properties, it was a similar story. Lenders in the US saw application volumes plunge as mortgage demand cratered to a multi-decade low. And, all the while, the Federal Reserve welcomed the downturn as a much-needed correction, giving no indication that rates would be relaxed anytime soon. Meanwhile, in Canada, where around a third of homeowners have variable rate mortgages, the central bank's aggressive rate hikes crushed affordability. This pushed some borrowers to default or consider selling, threatening a deleveraging cycle, where rising payments lead to forced sales, causing prices to fall further. In Toronto, which is among the world's most overvalued housing markets, house prices fell around 17% in 2022. Meanwhile, in the UK, where mortgages often involve short-term fixed rates for 2 to 5 years, homeowners were particularly exposed to payment shocks when refinancing. Prices were sliding even before Prime Minister Liz Truss's disastrous tenure tore a hole in the bond market. The Truss affair caused around 1,700 mortgage products to be withdrawn in a single week, pouring fuel on the bonfire of consumer confidence amid the UK's rising cost of living. So perhaps you can see why we and many other commentators were feeling pretty bearish about the housing market at that time. Some pessimists even warned about a 2008-style global housing crash, which is always good clickbait fodder. The comparison, though, doesn't stand up to scrutiny, and anyone waiting for another spectacular crash will have had a boring couple of years since 2022. So, does this mean a crisis has been averted? Of course not. Why do you think I'm making this video? To understand what's happening now, you have to begin by recognizing the battlefield is fundamentally different now. If 2008 was a housing market heart attack, the 2020s have been more like a real estate sugar binge leading to a chronic tooth decay. Where shall we start? Firstly, the structural underpinnings are simply more robust this time around. The era of reckless lending that fueled the last bubble is long gone. Those ninja loans, no income, no job, no assets, are history, and strict requirements are now in place for mortgage applicants. Lenders demand solid credit scores, documented income, and rigorous debt-to-income ratios. And that's why we're now much less likely to see mass defaults from unqualified borrowers who probably shouldn't have been given a loan in the first place. Secondly, and perhaps more importantly, homeowners today are sitting on mountains of equity. Back in 2008, people were borrowing sometimes up to 100% of the value of their home. meaning that when prices fell, millions were plunged underwater and into negative equity. And when your house is worth less than your mortgage, you've got a grim financial incentive to just walk away from your home and let the bank deal with it. Now, the situation today is the exact opposite. Over half of all mortgaged homes in the US have more than 50% equity, meaning that homeowners own a big chunk of the value of their home. Even if prices fall, owning a majority stake in the property makes homeowners far less likely to default, even when facing financial strain, because they have too much to lose. And third, the supply situation has been reversed. The 2008 crisis was exacerbated by a glut of homes from a decade of frantic overbuilding in the US. But now, the US and many other countries are suffering from a persistent structural shortage of housing. For years, demand has outstripped the available supply, creating a floor under national home prices and preventing the kind of widespread sharp declines we saw in the previous cycle. So, if we're not heading for a crash, what's all the fuss about? It may be a low-octane crisis this time, but it's a crisis nonetheless. And that's because we're witnessing a housing market paralysis, a persistent affordability crisis, gridlocked supply chains, and fractured demand picture have combined to cook up something we might call the Great Stagnation. Let's start with the most obvious and painful symptom of this disease, the affordability crisis. To say that it's challenging to buy a home today is an understatement. In many wealthy countries, buying a home is mathematically impossible for a huge segment of the population. This spring, the median home sale price in the US reached $414,000, an all-time high for the month of April and the 22nd consecutive month of year-on-year increases. At the same time, the average 30-year fixed-rate mortgage has been stubbornly hovering near 7%, almost exactly where it was 2.5 years ago. Put those two numbers together, and you're looking at a pretty ugly picture. Nearly 75% of all US households, which is about 100 million households, cannot afford to buy a median-priced home. The market is hypersensitive to these numbers too, as a mere $1,000 increase in the price of a home is enough to push an additional 115,000 households out of the market. A tiny quarter-point increase in the mortgage rates excludes another 1.1 million households. The mortgage burden has swollen to intolerable proportions since 2022. For a family earning the national median income, about 36% of their earnings are now required just to cover the mortgage on a new home. For a lower-income family, that number rises to an absurd 72% of their income, more than double the official threshold for being cost-burdened. This has created a mortgage gap that has split homeowners into two distinct economic realities. On the one side, you have those who locked in mortgages during the pre-2021 era of zero interest rate policies. These are the haves, insulated from inflation. Their payments are stable, their equity has ballooned, and in real terms, their housing costs are actually shrinking. And that leaves us with the have-nots, which is, everyone else. New buyers, renters who want to own, families who need to move for a new job or a growing family. They are facing the full force of today's prices and today's rates, and the financial strain is immense. This division explains an apparent contradiction in today's housing market. Why prices remain stubbornly high even though nobody can afford to buy a home.
Oh, I didn't see you there. Well, now that I've got you, I may as well let you know about the Coin Bureau Deals page. It's over there where you'll get $100,000 sign-up bonuses on the best exchanges in crypto, as well as 60% trading fee discounts on said exchanges. And you can also get discounts on hardware wallets. All of that in the Coin Bureau Deals page down below in the description. Now you go back to the video, I'm going back to chillaxing.
And this leads me to our second problem, the supply paradox. Common sense suggests that if fewer people can afford to buy, prices should fall as supply grows faster than demand. But that isn't happening on a national scale, at least not in the US, UK, and Australia. And that's because of something called the lock-in effect, which is exactly what it sounds like. In the US, over 80% of current homeowners have a mortgage rate under 6%, which is subsequently lower than what they could get today. And this means that a vast majority are locked into their homes by their own good fortune. After all, nobody wants to sell their home only to buy another at double their monthly payments for a comparable property. You would only do that if life events compel you to move. Of course, that does happen, and so the lock-in effect will erode over time. But right now, the financial disincentive is keeping millions of existing and often more affordable homes off the market, strangling that supply. Now, you might be thinking, okay, then why not just build more homes? And that's a good question. If demand for affordable housing exceeds supply, then ideally market forces will sort it out because this presents an opportunity for the builders. But here is the other side of the supply paradox. In the US, new construction is slowing down dramatically. Building permits recently dropped to a nearly 5-year low of 1.39 million units, and housing starts fell even more sharply to a 5-year low of 1.25 million units. And this is far below demand, which indicates that the US needs at least 2 million new homes every year. Builder confidence has plummeted to one of its lowest points in over a decade. In a sign of desperation, 37% of builders are now cutting prices and 62% are offering sales incentives just to move the inventory. They're facing higher material costs that aren't helped by new tariffs, which are projected to increase overall construction costs by 5 to 7%. There is also a persistent labor shortage, and this isn't helped by mass deportations of undocumented migrant workers. According to the Hispanic Construction Council, a non-profit think tank, around 700,000 to 1 million US construction workers are undocumented, and their deportation would devastate the industry. A new study from the University of Denver found that the lack of skilled workers cost the sector $10 billion and prevented the construction of 19,000 single-family homes last year. So, homeowners aren't selling, and new construction is nowhere near enough to meet demand. Rather than rebalancing, the market is stagnating at a very high price point. And that brings us to the demand side of the equation, which is just as fractured and strange. You'd think that demand would be weak across the board, but the reality is that it's a ferocious competition, just concentrated in specific segments. The biggest players in the market right now are, surprise, surprise, baby boomers. Aged 60 to 78, they represent the largest share of both home buyers and sellers in the US. Many have immense equity from decades of home ownership, allowing them to make all-cash purchases, which makes them completely insensitive to the problem of high mortgage rates. At the other end of the spectrum is Gen Z, who make up a tiny 3% of buyers. Despite a strong desire for home ownership, they are being systematically priced out. The median age for a first-time buyer is now 38 years old, and their share of the market has fallen to a historic low of 24%. Many are now completely reliant on financial help from family to even consider a down payment. Now, there is another character in the demand story, and that is the investor. But if you think this is going to turn into a plot twist about Larry Fink buying up all the homes in America, you clicked on the wrong video. The data show that the large institutional investors like BlackRock have actually been scaling back real estate investments. But as institutional investors have pulled back, small investors, so individuals or companies buying fewer than 10 homes, have become increasingly dominant and now account for a record 59.2% of all investor purchases. And which homes are they buying? Entry-level properties in high-yield rental markets, particularly in the Midwest and the South, which represent the last vestiges of affordable housing in the United States. These investors are in a direct bidding war with the very same first-time homebuyers who are already struggling to get a foothold. So you have this three-way battle for a limited pool of affordable homes: cash-rich old buyers, yield-seeking small investors, and hopelessly outgunned first-time buyers. It's a recipe for permanent price pressure at the entry level of the market. So, the market is stagnant, unaffordable, and gridlocked. It's not a crash, but a crisis in slow motion. And now we're starting to see cracks appearing beneath the surface in certain markets. Firstly, the US is seeing a slow upward creep in mortgage delinquencies, meaning people who have missed up to 2 months of mortgage repayments, and foreclosures, which is when the lender of a delinquent mortgage takes back the property or adds late fees that negatively impact the borrower. To be sure, the numbers are nowhere near 2008 levels, and the delinquency rate of around 4% is still low by historical standards, likely thanks to stricter lending requirements nowadays. But there is an undeniable trend pointing to distress in some markets. US foreclosure filings in May were up 9% from a year ago, while completed foreclosures, meaning bank repossessions, shot up 34% in the last year. The pain is concentrated in particular hotspots, with states like Florida, South Carolina, and Georgia seeing the largest increases in delinquency rates. Florida is a particularly significant case because it was one of the markets that became the most overhyped during the pandemic housing bubble and is now cooling fast. Here, the market paralysis has been broken by sellers capitulating, causing house prices to plunge. Real estate analytics provider Parcel Labs highlights 6 major markets in Florida, namely Orlando, Tampa, Cape Coral, Lakeland, Northport, and Deltona, that are undergoing the sharpest downturns. Together, they have appreciated on average 53% since 2020, about 11% above the national average at 48%. But over the past year, these same markets are now down around 4.5% on average, more than 10 times the national average of 0.4%. The pessimistic take here is that Florida is merely one step ahead of the rest of the country, giving America a preview of an impending real estate bear market. But that's not all, because there is another, possibly more ominous signal coming not from the residential market, but the skyscraper next door. That's the commercial real estate, or CRE, a sector that is in deep trouble. A new analysis of commercial mortgage-backed securities debt shows 6.42% of borrowers were 30 or more days delinquent or in foreclosure. The office loan delinquency rate is at 7.8%, and the rate of loans transferred to special servicing, a sign of severe distress, has hit a 25-year high of 16.19%. And this is all coming to a head because of a massive $957 billion wall of debt scheduled to mature this year. Refinancing these loans at today's rate is going to hurt, and if borrowers start defaulting, it's very bad news for the economy. And that's because the institutions on the hook for these loans are disproportionately regional banks, which hold about $3 trillion in CRE loans, accounting for nearly 13% of their total assets. If these banks start taking heavy losses, they will tighten lending standards for everyone, threatening a credit crunch that could starve the residential market of financing. It doesn't help that all of this is playing out against a backdrop of major economic uncertainty. GDP growth has slowed, but inflation remains stubbornly persistent, driven in no small part by the high cost of housing itself. And this puts the Federal Reserve in a box. It can't confidently cut interest rates to stimulate the economy for fear of reigniting inflation, especially with new tariffs adding to price pressures. And this creates a policy-induced stagnation loop where high interest rates suppress housing activity, which contributes to the economic slowdown, which reinforces the cycle of uncertainty. And here's where I remind you that this isn't just a US phenomenon. We're seeing variations of these same pressures throughout the world, and particularly in the Anglosphere. In Canada, there is a similar affordability crisis, but with a ticking time bomb in the form of a mortgage cliff. Over $300 billion worth of mortgages are set for renewal this year, many of which were signed when rates were at historic lows. The shock of paying 2025 rates is the last thing they need in a country where households already hold $1.74 in debt for every dollar of a disposable income. In the UK, a brutal cost of living crisis has been grinding away at household incomes for years. While headline house prices have remained surprisingly stable, the pain is showing up elsewhere. Mortgage repossessions, which are the legal steps required towards a repossession, are going through the roof, with repossessions by bailiffs up 42% year over year. 2.7 million households are still chilling on ultra-low sub-3% mortgage rates, meaning that a wave of pain is going to hit as they are forced to remortgage at current rates. Meanwhile, in Australia, the housing market has been distorted by decades of policy decisions that have prioritized investors over homeowners. Policies like negative gearing and capital gains discounts actively incentivized real estate investment over home ownership, costing the government billions in tax revenue. This has funneled investment into existing properties, driving up prices without creating new supply, in a prime example of how policy can be the primary driver of a national housing crisis. So, where does this leave us, and what does the future hold? Well, the central expectation is that mortgage rates are going to remain higher for longer. The days of 3% are gone. Our main takeaway is not that a bonfire is about to start, but that the new normal is a world where rates stay elevated and the affordability crisis slowly rugs most of us. For generations, home ownership has been the main road to building middle-class wealth and financial security, and a key pathway to accessing credit. But now, younger people are systematically locked out of the process, with serious implications for the already vast gap in generational wealth. And so perhaps, before you know it, housing might just be another subscription draining your bank account in between Netflix and Spotify payments.
Netflix.
Spotify.
Well, at least you'll have plenty to watch and listen to in order to take your mind off it all. Now, if you enjoyed that video, you're going to love our latest one right over here. And if you're not subscribed to the channel yet, you can do that right over here. This is Nick signing off. Thank you guys very much for watching, and I'll see you again soon.